Thank you for joining me today to go through our three-bucket theory on investing. My name is Benjamin Hawes of the Hawes Financial Group, and our mission is to help you align your personal values, vision, and wealth by sharing what we know about financial planning and investing through a personalized planning process. Before jumping into the content, I'd like to provide some context for how we think about investing in retirement and why the three-bucket theory has its place. The reality is, investing can be really emotional. And as we age and approach retirement, you might end up facing multiple risks that can just simply make you uncomfortable. Rising costs of healthcare when you're off an employer plan, unexpected events that can pop up that require tapping into your savings, market volatility and the fear of having finite resources means you can't afford to see losses on your statement or they make you uncomfortable. Longevity and the worry of running out of money, inflation and seeing the price of everything you feel like you spend money on going up over time, and withdrawal rate, taking too much out of your savings to live on too early in retirement. So here's an example of how those risks maybe manifest themselves. If you fear market risk and invest too conservatively, you might avoid market volatility, but then inflation can eat away at your purchasing power, or you might not be able to keep up with healthcare costs, and the risk of running out of money becomes more likely. So the flip side, you could take too much risk, and then maybe you need to withdraw at the wrong time based on market volatility, or you withdraw too much, in concept, killing the geese that are supposed to be laying your golden eggs later in life. So the point here is that there really is no silver bullet to investing that's going to help you manage all these risks on their own. So we say the goal should be to balance these risks and our emotions about these risks by electing different strategies to different objectives over different periods of time. So let's jump in. What we're going to talk about today are three different buckets, and that will be defined by short-term, medium-term, and long-term, which we're going to define shortly. The key input into this plan to start it is to understand how much you need and want from your savings to supplement your other sources of income, be that Social Security, pension, maybe it's real estate income, part-time income, whatever those resources may be. So we believe that a financial planning process should dictate that, which we say is the best place to start. Because once you figure out that gap, that number, we can then break your savings into three buckets. That being, again, your short-term bucket that needs to fill your bank account, fills that gap from your income and your expenses. So here's how it works. That first bucket, the short-term bucket, we suggest you hold 1 to 2 years of that income need, whatever needs to come out of your savings to supplement your other income to meet all the expenses that you feel you'll have. So for example, if you need $50,000 coming from your savings in any given year, then we would tell you to hold $50,000 to $100,000 in cash. And we believe this bucket should be filled with checking, savings, money market, CDs. Now you may be thinking, but Ben, I'm not making any meaningful interest on these savings accounts. Aren't I just safely losing money to inflation? That may be the case in certain environments, but making money in this bucket is not the primary objective. Preserving your principal is. You want to rely on this bucket for your regular needs, emergencies that can arise, opportunities, regardless of market movement and where the market is on any given day. There should be no trading that needs to go on in your portfolio to meet your predictable income stream. Now, why do we say 1 to 2 years? Because historically, the average market decline, right? The decline that occurs when the market's not performing well, maybe it's leading into a bad environment in the economy, a recession per se. The average decline is 18 months. So by holding this in cash, I hope that you can simply turn off the news, ignore the swings in the market, because having this cash is like giving yourself the permission not sweat those short-term, month-to-month, quarter-to-quarter, even year-to-year swings in the market. So the money you plan to spend on taxes, healthcare, that summer vacation, whatever it is for you, that money you should have earmarked, for the money for the next 2 years should be earmarked and in a safe and predictable spot not to be affected by the market. Collecting interest on that money is actually a secondary objective. Now, if your cash and cash equivalents aren't producing income, then you need your second bucket, your medium-term bucket, as I'll call it. And that needs to be the bucket that is going to be filled with income producing assets, or said differently, assets that generate income for you. This should be filled with 3 to 7 years worth of your income need. So going back to the example of needing $50,000 a year of income from your savings, we then suggest having $150,000 to upwards of $350,000 in this bucket. And the key to this bucket is that the income produced by the investments, the assets in this bucket, they should be passed forward. Their objective is to replenish that which is being spent from your short-term cash bucket. Any interest, any dividends should pay to cash and not be reinvested, which is very typical when you're saving and accumulating for retirement. The additional point to make here is that while investments in this bucket are typically more conservative in nature, right, if they're paying you income that you're having paid to cash, that doesn't mean that their value won't fluctuate. We just believe you need not worry about that change in value of the investment too much, because its main objective is to produce that income. And if you just continue holding that asset, whether it fluctuates in value a little bit or not, is not a big deal. Think of this like the house. That is the roof over your head. You're not planning to buy and sell the primary place you're living in any given year. Its objective is to be a roof over your head, even if the value of your home fluctuates a little bit. So this speaks to fixed income and the bond market as assets that typically are filled in this bucket. Their products and investments with income streams and maybe even annuities would fall into this consideration as well. Now, why do we say 3 to 7 years? Because historically, most market cycles last 3 to 7 years from start to finish, right? From peak to trough and back. And historically, when those downturns occur, sometimes referred to as a bear market, if it gets that deep, there's a flight to safety. There's a flight to cash or fixed income. And that may mean that filling this bucket with more conservative assets, you're giving yourself not only a whole market cycle without having to rely on equities to perform well, but there are often times when there's an inverse relationship between stocks and bonds may actually perform even better during the downturn of markets. So that's going to lead us to the last bucket, where we're going to suggest, regardless of your risk tolerance, going back to the plan, you should always consider investing for the long term, 7+ years from now. Remember, just because you retire at 62 or 65, that doesn't mean you can't take risk anymore. We would say quite the opposite. You're going to need those growth opportunities. So if you retire at 65, statistics say you could live 8,000 days in retirement, with life expectancy being to age 87 or 88. So while your appetite for risk naturally goes down, we know that our savings is finite, right? You're no longer saving. We hope you recognize that part of this process is already covering the short-term volatility concerns by having those first two buckets. We hope you've already given yourself permission to tolerate that volatility in the long-term bucket, because you don't need these growth-oriented investments anytime soon. You can let them sit and recover over time as they historically do. Now, most important to the plan is that we don't get greedy. It's that these assets, we hope they will keep up with inflation over time, right, to keep up with rising healthcare costs and help ensure that a long and healthy life into your 90s isn't a risk. That by taking this long-term view and not panicking while values drop, you give yourself the discipline then to pass gains forward when they occur. Right? The market goes up more than it goes down. The key here is to pass those gains forward into the medium-term bucket. This is like a conveyor belt. When times are good, we sell our gains. We buy more of the safe things. We don't leave all the chips on the table. We let that engine, as I want to call it on the back end, pass the gains forward during the good times, and we wait for them to recover during the difficult times. This bucket would typically be comprised of different equity investments, which we recommend to be diversified across different sizes, different spots in the world, but portfolio construction is a conversation for another day. Now, I'll end it there and hope that this was helpful in considering how we believe you should consider crafting an investment plan. Again, we believe this is best started going through a financial planning process that will define your income needs, wants, and wishes, and then inform how to bucket your savings into specific periods of time, with these different objectives, giving yourself the opportunity to hopefully just feel okay when the markets get volatile. And that way you can manage multiple retirement risks by not trying to just hone in on one sole strategy, but rather look at this as 3 interconnected strategies to give you more confidence over time. Hope that was helpful.